Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us on our Tuesday Market Insights and Observation edition. This is January 24th of 2023. Three main topics, moving markets we're paying attention to. You should be too, so thanks for following along. Let's get right to it right now. So right out of the gate, we're talking about earnings insight. So our fact set basically does a recount of all the S&P 500 earnings, and essentially it's a scorecard, and we'll get to that. We're also going to talk about the two indicators to watch moving forward on the S&P 500, which is really going to give us an indication of which direction, whether the markets move higher, break out, or move lower as a result. And there's some key indications right now to pay attention to on the S&P 500, and that's also what the bears are watching. So let's get to the next slide right here. Let's see here. Again, the key metrics, don't worry about seeing exactly from where you are, but I'm just going to go through this right now on a high-level overview. We're looking at the scorecard for the fourth quarter. Remember, the earnings that are being reported by the companies right now are the last quarter of last year. So again, economically, if you think about last year, as we saw, not only was the market was down because it was anticipating negative earnings for this reporting season. So we ended the year on a weak note with regards to all of the Dow, the NASDAQ, and the S&P 500, already discounting worst case scenario. It's almost, again, like, when we have our kids in school, and we're anticipating, let's say, the worst case scenario because they may not have prepared themselves as best as possible for that test. They get the test and then they exceed expectations. Corporations, C-level executives like CEOs, CFOs, middle management kind of tend to do that. So we'll see how this plays out right now. But as of right now, we've only had the 11% of the S&P 500 reporting, and over 67% have exceeded those expectations right here. That's a little light. Usually we see a 70 plus number. So it's showing that earnings are coming in a little bit light all across the board right now. And then we also want to pay attention to earnings guidance for the S&P. And only two companies have literally issued positive earnings growth out of the 11% that have earned, or at least reported right now. So sort of one could say it's a mixed bag. And ultimately, what we're going to pay attention to here is right now the S&P 500, the PE ratio is below the 5-year average of 18.5. So that means that valuations, how the market is priced right now relative to earnings and future earnings potential, is actually pretty in line. It's actually below the 5 and the 10-year average at the 17 PE. So that's a sign that we're not overvalued in the market at this moment in time. So that's a good setup for what we're going to see and experience in earnings seasons. Now, this next slide, the S&P, basically forecasting the 12-month earnings per share versus the price. The price is where the S&P 500 is. Right now, we're at the 4,000 level. And so that's the blue line. The blue line is the price movement. Obviously, by year end, we saw this decline towards the last year end. But what's good about this right now is this right here, we have both the forward price earnings anticipation or estimates with regards to the earnings per share and the price of the S&P. They're all together right here. It's a good sign because it just means, again, it proves in line with now the markets are sort of being more realistic and fair valued at this moment. And why would that be? Well, because we're seeing positive notes on U.S. inflation and the headline and the core CPI, what the Fed's were watching at, what you and I are paying attention to. They're moving in the right direction, which is coming down. And ultimately, that's important for the Fed to engineer a soft landing. But the risks right now to the U.S. are still skewed to the downside based upon the confidence board. So the confidence board, the U.S. leading indicator of companies in terms of how they feel they're going to allocate capital moving forward or invest in their businesses, or just any capital allocation with excess free cash flow. Or if you're lower on the chain, you don't have excess free cash flow, in your company with lower quality, lower balance sheet, we don't invest in that direction for our clients. We only stay up at high quality. But even at that, it's still part of the market. And so corporations are sort of battening down the hatches. And we're seeing headlines. If you look at the Wall Street Journal and read the headlines every single day, every corporation is doing the pausing on hiring and laying off. And again, that's exactly what the Fed wants. They want to close that JOLTS, the job openings to the job, sort of those that are in need, gap, if you will. Again, we're getting better, and those trends are still in a favorable position. But this right now is indicating If history is a guide right now, and that's where you see all the economists and everyone on Wall Street is saying, hey, listen, we don't know it's if, it's when a recession will hit the U.S. economy. One of the best indicators in the past has been this particular report that we get and we follow. And if you look at back in 1970, when you have this baseline number, what this is when the confidence number drops to where we're seeing it even today, and historically speaking, in the 70s, 75, 80s, we're seeing it a couple of times, 90s. We had a dip there. We had it in early 2000s, if you remember, 2008, most recently during COVID. Every single time, and it's matched up with these gray bars here, gray bar here, gray bar here. These are recessions. So this is a recessionary indicator. If you want to go by history, here's our guide right now. And again, a lot of that has been, not majority of that's been priced in, but a lot of that price movement in terms of the S&P moving down at the year end is also anticipating this and pricing that in. Now let's go to two indicators to watch. It's very interesting. The S&P 500, we have two charts here. And the first chart is we're looking at the S&P right here and the moving averages on the 3-month highs. The 3-month highs we've seen recently are actually positive. So we're seeing every day that's being reported, a company's making on a stock basis a 3-month high. So not every company, but this is looking at the S&P 500 and looking at, we are seeing some net positives, and that's a positive sign. And then that takes us to the 200 and the 50-day moving average. Now, this is in the red line and the green line. And when they cross, you could see a potential breakout to the upside to, let's say, the index. In this case, it's, again, the S&P. If we go back in history, every time we have a crossover, we see a positive breakout. It doesn't happen all the time. We had a false positive earlier this year, or actually late last year, but we're at that breakout point. So what's really going to be, and then this one's just showing about the 50-day, how many stocks are actually exceeding above their moving averages. And so it's getting closer every day. A lot of companies are actually, their price action are improving. So it's underneath the market. Are there positive developments internally in the S&P? The answer is yes, but again, cautiously optimistic. We're very conservative in nature here at the Blanke Schein Wealth Management shop. And we're also saying, hey, listen, this is not a deal breaker. There's subtle momentum, and any loss, the bears are watching. And where would the losses come from? And it's just coming down to earnings. We have big earnings season. This 34% of the S&P is reporting this week. Again, another 30% next week. So the next 2-week stretch, we will see the big techs, we'll see the big names in every sector of the economy. We're going to get the progress report of how they ended 2022, but also how they're going to guide through this year. And I think with the unknown with regards to the Federal Reserve and interest rates, the unknown and some of the geopolitical issues that are out there, the unknowns on the economy and the U.S. consumer, small business owners are, again, being cautious moving forward. So it wouldn't surprise us if we saw the guidance be negative to lowering expectations. Again, like our kids, when they go take a test, I don't think I did so well. And then, hey, listen, they come home with a better grade. It's historically what we see with the S&P 500 with executives walking through earnings season, especially with all this unknowns out there. But it also is, you know, we own quality, we're positioned, we've got treasuries and cash. We could deploy if we see some opportunities, like I said before, when the market comes our way and gives us opportunities. So we're positioned nicely for that. That's the update for today, the indications to watch, what bears are watching, and ultimately the earnings insights. Thanks for watching, and we'll see you again next time.